Okay, today we're going to take a look at comparing whole life insurance to term life insurance and why term life insurance can be a much better decision if we have the discipline to invest the difference. Because whole life insurance is much more expensive than term life in almost all aspects, regardless of what age we decide to take out insurance. Now, the difficult thing with insurance is when we most need it is when we're young. We may be in our 20s or 30s. We have a home mortgage, maybe we're married, we have children, so we have a reason to really need life insurance when we're young because we don't want to possibly leave a burden for those left behind if something happens to us. However, also when we're young is when we're probably least able to afford it. So therefore, cost is a decision for a lot of people, and it keeps people maybe from having adequate insurance. So let's take a look at the premiums and see what would happen if we would invest the difference of these two. So the first example here, we're going to take a 25-year-old female, and all of these examples are with having $500,000 of life insurance. In this case, we're going to start with a 25-year-old female in good health, not excellent health, just good health. And all of these quotes are recent quotes from major insurance companies, well-known insurance companies. I'm not going to single them out. But this first example for our 25-year-old female, we have a 30-year term. That means your policy would end after 30 years, and then after 30 years you would no longer have life insurance. But notice that that premium would be about $34 a month, okay, for a 25-year-old female. It would end when, therefore, she is 55. Whole life insurance, which you must pay for your whole life, and then, of course, whenever something would happen to you, you would receive the $500,000. But notice that's $320 a month, and that's the decision that so many people have to make, typically because whole life insurance is so expensive that we sometimes lessen the amount of insurance that we're buying so we can afford it. But what if somebody would take that difference, okay, between these two, the savings of choosing the 30-year term over the whole life insurance, and invest the difference into the S&P 500, which, and if you notice in some of my other videos, over any 20-year period or longer, we can figure a 10% rate of return. That's what the S&P 500 has pretty much always done, and that of course includes dividends. Now, if we would have invested the difference for those 30 years, investing the difference growing at a compounded annual growth rate of 10% would have grown into $646,000 and 500, of course. Okay, so notice at the end of 30 years, yes, the term life runs out, but you already have more money than the $500,000 of insurance that you would have had if you would have been paying the whole life. And of course, to keep the whole life insurance, you would have to continue paying that premium forever. Now, what happens then if you would now take the difference and just keep investing? Okay, at the age of 65, you would have $1.8 million, and that would be your own money. Okay, yes, whole life, sometimes they have various degrees of that. Sometimes you can borrow against it. It has a cash value. Okay, you're really borrowing your own money. Like I said, if you would have been just invested the difference at the age of 65, you would have 1.8 million. Okay, so that's why companies a lot of times love selling whole life insurance as opposed to term, because of course it's very profitable for them. Now, this is for a 25-year-old female. Let's take a look at another example. Here's a 35-year-old male, again, just in good health, not excellent health. These are very current premiums that they would pay. For a 30-year term life insurance, they would pay $56 a month. Okay. Again, this varies a few dollars depending on the company and stuff. Whole life insurance is $510. Notice in each of these cases, whole life insurance typically is roughly about 10 times more expensive than term life for let's say a 30-year term. Now, again, if we would have invested the difference and invested again into a low-cost index fund for the S&P 500, so you're not paying a bunch of fees, okay, at the end of 30 years, investing the difference would have grown into over $1 million. Okay, so yes, at the end of 30 years, you no longer have life insurance, but you don't need it. You have over $1 million of your own money saved up just investing the difference. Okay, and that's again at age 65, retirement age. Now, our last example, a 45-year-old female. Okay, again, this is an example of, again, just good health, not excellent health. But a 45-year-old female, a 30-year term life insurance, known as now, it wouldn't run out until the age 75, would cost $76 a month. Okay, whole life, $625 a month. Again, to receive that premium for whole life, you have to continue paying that premium until death. Now, if you had invested the difference at the end of 30 years, a little over $1.2 million that you would have of your own money. So yes, you no longer have insurance at the end of that 30 years, but you have, look at that, more than twice the amount of insurance that you were paying to receive with the whole life. Okay, so again, here's 3 different snapshots, a 25-year-old, a 35-year-old, and a 45-year-old. Okay. People, if they have the discipline to save and invest, are much better off buying term life insurance and then save and invest properly. A good rule of thumb is never mix insurance with investments. Okay? You shouldn't mix those 2 products. Keep them separate. Buy the insurance you need, buy the cheapest, which is term, and then invest properly. Okay, and I have some other investment videos online if you'd like to take a look at those. Okay, so hope you found this helpful, and I will see you next time.